Howdy there, folks. Welcome into today's video. It's a buy one, get one free today in this one. Okay, first one up here, a little 1 minute, 2 minute clip to react to. Jeremy Grantham, the legend himself, says a U.S. recession is going to run deep into next year. Want to hear what he has to say, kind of share my perspective and opinion on what he has to say. Always interesting whenever Jeremy Grantham speaks, and we can kind of hear his perspective on where things are heading here. Okay, then I want to listen to Mohamed El-Erian on his kind of perspective on what's going on here with the market, the economy, what's about to transpire and happen here, and I'll share my perspective. So definitely some two very, let's call it famous people in regards to financial markets to react to in this one here today. So appreciate everybody joining me as always. We had a situation in the Patreon earlier. I notified everybody pretty much as soon as this happened. Very interesting. A lot of times you'll see this crap on like Instagram is the worst in my opinion, but you also see it in like YouTube comments and things like that. People basically like impersonate my account, but the thing they messed up on is they impersonated the profile picture from this channel, like the Jeremy Lefebvre Makes Money channel, rather than my actual Patreon. But anyways, they just messaged like, everybody left comments on everybody's comments, to message them on Telegram and all that crap. And, if you guys ever see stuff like that, report it to me. Let me know what's going on. I said someone's using my name and image here to try to scam for crypto and Telegram. Never message me on Telegram, WhatsApp, or any of that crap, because almost always they want to do it on some sort of Telegram or WhatsApp whenever they do this stuff. And also never send any crypto to anyone. So, because usually what they'll try to talk you into, I don't know, they'll be like, oh, I can get you all Jeremy's courses, or they'll basically act like they're me and then say like, oh, I'll give you all my courses and just send me some doggy coin or whatever. Like, no, okay. No, I don't even do anything in relation to transactions for myself. If you want to get in the private stock group, which we never have this issue because you have to get vetted to get in there, right? You have to speak with O-Man on the phone or actually, do a meeting with him. So you're going to be like well vetted. But for Patreon, anybody can join there, $19 and you're in. So that's the issue. So we're to keep a very close eye on any of this and obviously report it if we see any more of that crap on Patreon. But just understand, like all the big finance YouTubers, they do this crap too. So keep an eye out there. Report stuff to me if you ever see something suspicious. On Instagram, I'm verified on there, so it has like a blue check mark thing. So they'll try to impersonate my account on Instagram. Always, if you're trying to communicate with me, make sure you click on my account. Make sure it's my account you're basically talking with, because they'll try to, put a very similar username that's just like one letter off, but you don't quite notice it, and they'll use my exact profile picture. So keep an eye out for all that stuff, guys. Alrighty, let's get into this.
Deflationary forces from the tech stocks breaking in 2021, probably too big. The power of interest rates rising and depressing the real estate market, very negative, slow-moving influence. I suspect that they will...
Thank you. And that's what people don't understand about these interest rates going up so much as they have over the past year and a half, is especially when it comes to real estate market specifically, very important to understand this. It is a slow mover. It is not like it's overnight and it causes a ton of real estate damage. It just slowly gets worse and worse and worse as rates are higher for longer. And it starts hitting the housing market more. And then you have people start bringing down prices more. Rents obviously start falling. You kind of get this whole situation that happens, but everybody wants it to happen immediately. It usually takes 2, 3, 4 years for this to play out. And we are only into this hiking cycle for about probably a little less than a year and a half now at this point in time. So you'll see much more effect in 2024 and potentially even into 2025 in regards to real estate.
Once again, dominate, and we will have a recession running perhaps deep into next year, and an accompanying decline in stock prices.
So the recession that you're predicting is probably not going to happen.
So he's predicting real estate falling, stock market falling, and recession running deep into next year, which probably means, back half of next year into next year.
2023.
But it may start in 2023.
The Federal Reserve recently said that they think we've cleared the recession hurdle, and they don't.
It's super tough to get this recession in 2023. The reason being is we're about to go into holiday season. Obviously, there's always a lot of hiring. Unemployment's still so low. I think you could potentially get it in 2024 in the first half or second half, but to get it this year, I think is it's not impossible, but I think it's very, very tough now at this point.
They project a recession any longer. Right. You disagree with the Fed on that?
Yeah, I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have
wonderful
never
meaning
called
horrible.
A recession, and particularly not the ones following the great bubbles. They prided themselves in stimulating the bubbles. They took credit for the beneficial effect of higher asset prices on the economy. They have never claimed credit for the deflationary effect of asset prices breaking, and they always do.
Now, you said not too long ago that you weren't a big fan of Jay Powell and the way he's been handling inflation. Is that correct?
Yes, that's correct.
And you think he's done a better job recently in getting inflation under control?
I think it's largely out of his hands. The forces work. I suspect inflation will never be as low as it averaged for the last 10 years, that we have re-entered a period of moderately higher inflation and therefore moderately higher interest rates. In the end, life is simple. Low rates push up asset prices, higher rates push asset prices down.
Yeah, so it sounds like, first off, it's kind of depressing, right? And when I say it's kind of depressing, what am I talking about here? Okay, what I'm talking about is the fact that this video only has 16K views, and then people dancing around on TikTok have millions of views. I'm just like, man. Jeremy Grantham speaks, 16K views. Like, seriously, come on, man. Legend, But anyways, in regards to this whole situation, right? So if we're going to have higher inflation, then you have to believe that whatever recession we have is not going to be a super bad one. Because if we have a super bad one where unemployment climbs substantially, you're going to see deflation, if anything. So that's where I kind of would push on Jeremy Grantham if I was doing the interview, and I say, well, wait a minute, does it make sense? What do you expect in kind of a mild recession then here that we're kind of get into, a medium recession? Because if you're expecting a bad recession, you get deflation that ends up coming in that situation. You have very low inflation for quite some time as you kind of come out of those years. So that's just, business climate gets harder and prices get compressed, margins get compressed. That's just, that's economic cycles 101, right? But, obviously he's basically predicting that the market's going to get hit. And real estate market's going to get hit. That's what he's predicting there. So we'll see how this transpires. But yeah, very interesting. Already, Mohamed El-Erian on markets. As far as my opinion, there's a reason I'm doing some hedges, right? Going into 2024, several different hedges. The reason being is I'm concerned as well for next year in terms of how the market performs, in terms of what actually happens with the underlying economy. So I'm basically doing a plan right now where I'm buying assets that I believe are very undervalued that from the long side, keeping cash around, collecting that 4 or 5% I get on that. And then I'm also doing hedges in case this thing gets ugly next year. Mohamed, let's listen to him.
What's behind this monster move, not just of the last week, but the last month?
In order of importance, John, supply, first and foremost, followed by a revisiting of the growth prospects to stronger growth, followed by a recognition that inflation may be sticky over the longer term, and then finally, people are keeping an eye on what's happening in Japan. So you've had these four things come together. Supply has been the main drivers, and the others have contributed.
Mohamed, given the reasons you offer, are there also reasons to believe then that these kind of levels are sustainable?
Yes, John, but a lot will depend on what Chair Powell decides to do next Friday. And he has a range of choices. He can talk about short-term monetary prospects, he can talk about longer-term monetary prospects, or he can punt both and focus on some of the challenging economic issues facing the U.S. economy. But what he says is going to be critical in terms of what it does to the bond market. The other thing to keep an eye on, and you've mentioned it, is China. I don't think people recognize enough that you've had two long-standing problems coming together. First, pockets of debt and leverage becoming systemic, and second, an inability to generate high and genuine economic growth. And suddenly, these two things are merging and risking financial instability a la Chinese. And that's...
what's crazy about this whole China situation is we have known this is going to be a problem for nearly a decade now. I remember hearing back in like 2014, 2015 about all the building they were doing in China, these ghost cities that they were constructing. It was just out of control. But that was like, man, that was so many years ago. And it's crazy that it's taken up until really like this past year or so for it to finally start coming crumbling down. And it's interesting when you have that long of a buildup, you sometimes you got to think to yourself, like, how bad is it going to get in terms of kind of like, does it take 2 more years to bottom there, a year, 3 years, 4 years? Like, what are we talking about there, right? But we've known that is going to be a problem for quite some time. By the way, I feel like I moved to Malibu or something, man. It is absolutely gorgeous. It is like 70-something degrees out here. We got a slight rain. Oh, my gosh. I mean, for Vegas in August, we will take this. Thank you.
Something to keep an eye on as well.
Well, let's break down those two things, and we can start with China, and then we'll work our way back to Jackson Hole and Chair Powell's address about a week from now, 10:05 Eastern Time, for those of you not familiar with the time. That release came out just yesterday afternoon from the Federal Reserve. China's done a range of things this week, Mohamed. I'll go through a few of them. China has delivered the strongest pushback in the FX market with a really strong fix for the currency overnight. We know they requested state-owned banks to escalate intervention to support the currency, based on our reporting. We also know that mainland exchanges have asked some investment funds to avoid net selling of equities. They've even asked some companies to buy back stock. Mohamed, it seems like it's all insufficient.
Wow.
What do they need to do to draw a line under all of that?
It's crazy. The Chinese government's basically doing everything. You guys need to buy back stock. You're not allowed to sell stock right now. It's crazy, man.
So what they're trying to do, John, is to stop these problems, the debt overhang and the growth issues becoming financial problems. So everything you've cited is an attempt to short circuit the financial instability. But that's not going to work unless they address the two fundamental issues. And you and I have been talking about this. On the growth side, then the muddled middle. They're not sure whether they want to do more of the traditional stimulus, which ultimately will not work, or do they focus on the reforms, which pushes down the growth drivers, something that politically is difficult for them. On the other side, on the debt side, they haven't dealt with a fundamental restructuring of the debt. So these small problems are becoming systemic in nature. So unless they address these other two issues, all the things that you've mentioned are not going to prove sufficient to avert financial instability. Already we're seeing outflows out of China, and that for them is a big issue.
Ben Laidler of eToro wrote a line yesterday, Mohamed, and he said something like, it's an economic giant, it's a financial market minnow. Is this an economic giant we need to pay attention to, or a financial market minnow that we can ignore? And what I'm getting at here, Mohamed, is whether this is a contagion issue, whether there is a prospect that this bleeds out into broader markets worldwide or not.
So that's a concern, but that's not even my biggest concern in regards to this whole China mess. My biggest concern with this whole China mess, folks, is it getting so bad that the Chinese government feels they need to get everybody's attention off of potentially what's going on with the economy. And so they make the move on Taiwan, because it would be a huge distraction, obviously, away from kind of what's going on with all this real estate collapse left and right. With all the I think they're looking at like 20% plus youth unemployment right now in China, which is insane. So, a great distraction would be if they made a move on Taiwan and start that whole thing. The government, all governments love to get everybody's attention off of something if something's going really bad for them, right? And they can kind of divert the attention over here from this other show that's going on over here. So that's actually what I'm more concerned with in regards to China than even anything else, to be quite frank. But there's many problems from many different fronts.
Won't bleed out through the financial channel. So because financially they're not as big as they are economically. But keep an eye on the economics. Now the global economy is almost wholly dependent on the U.S. economy. The U.S. economy is the bright spot. The U.S. economy is an economy that is growing and growing in a genuine fashion. Europe is having difficulties. The UK is having difficulties. China now is decelerating. So it is all about global economic growth and how much of the burden can the U.S. continue to shoulder, because China is now a detractor to global growth.
You just said, Mohamed, the global economy is highly dependent on the U.S. economy. Can we flip that? And I'll ask a question. How dependent is the U.S. economy on the global economy? Can we continue to see strength like this in the U.S. with weakness elsewhere to the places you pointed to?
We could. The U.S. has the privilege of being a large, relatively closed economy, well-diversified, entrepreneurial. So yes, we could. It's harder. because exports do contribute to economic growth. It is harder, but yes, absolutely we could. And that has been the story of this year, is that the U.S. has continued to do well and it's accelerating, even though the rest of the world has been very sluggish.
So the title next week, as you know, Structural Shifts in the Global Economy, which takes us to point 2 and Jackson Hole and Chairman Powell. Is he central banker to the world? To borrow a question from my good friend, Tom Keane. Do you think he is this week, Mohamed, into next week?
The Fed has always been central banker to the world. We issue the reserve currency. We manage other people's savings because we have the most deepest and most liquid financial markets. So yes, the U.S. Fed has enormous influence on the rest of the world. Look, John, you're going to make me front run yet again an FT article coming out on Monday. But Chair Powell has 3 choices, and it's not clear to me what he will opt for. What we know is he has lots and lots of topics he can cover. Short-term topics, longer-term topics, tactical ones, sectoral ones, structural ones. He has a lot to choose from. Ultimately, it's not clear to me what he will do.
If he picked out the structural reasons, Mohamed, if he picked those out, are there structural reasons to make the argument the rates can be higher for longer, than we have truly broken out of that pre-pandemic, post-GFC regime that we were in for the best part of a decade?
Oh, absolutely. And you've heard me say this. This is a different global economy. This is no longer an economy where aggregate demand is deficient. This is an economy where there's insufficient aggregate supply. We feel it in the labor market.
This is where the stock market's kind of in a very tough situation in the short term, okay? And when I talk about short term, I'm really talking over this next 6 to 12 months. Because on one side, you can say, okay, let's say economy starts getting hit really hard. 2024, we actually go into the recession, job losses start coming, boom, 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 okay? And then you say, well, at that point in time, Fed's going to obviously reverse course, start cutting rates. Okay, you could look at that as a good thing for the market, but it's also a bad thing for the market. Why is it a bad thing for the market? Well, if you're in recession, earnings are not going to be what earnings are the past couple of years. So they'd be a lot lower, okay? So that's not good for the market, right? Also, you know, if you're in one of those sorts of environments, a lot of people don't want to put money to work in the market at that time because a lot of people are scared because you're in a recession or unemployment's in a bad place and whatnot, right? Plus, not as many people can buy S&P 500 index funds, put money in 401ks, all that type of stuff, right? If, you know, they just call it you're in tougher economic times. On the flip side, let's say you don't have that. Well, let's say inflation still stays around the 3-4% range in terms of CPI, then you could be in higher for longer. Also, not a good thing for the stock market either, because then more and more people look out there and they're like, man, rates are in quite an elevated place. More and more people consider, I got to start moving some of this money over to savings, treasuries, things like that, right? Rather than keep this money in the market. And especially if you go higher from here, because people start looking out there and they're like, why am I going to have money in the market when I could have money guaranteed get me 5% or so, right? And then also feeling that eventually the Fed's going to break something by keeping rates, because we know the longer the Fed keeps rates in an elevated place, the higher probability you do have of something eventually breaking. It's just a question of, are you waiting months, quarters, or years for that, right? So yeah, either way, that puts the market in a pretty tough place in the short term. No doubt about it.
Feel it in terms of the supply chains being rewired. We feel it in terms of the energy transition, and the list goes on. So yes, this is structurally a very different global economy. And that's a problem because the framework is directed at an economy with insufficient aggregate demand. The inflation target, as you've heard me say, may be too low for this world. So yes, there's lots of reasons to argue that this is a fundamentally different economy, but it raises critical aspects in terms of monetary policy.
Well, let's talk about the monetary policy call for September, which sounds boring compared to what we just discussed. Is it too early to make a call as to what they may or may not do a month from now, given we still have one more CPI report and another payrolls report around the corner?
I think it is. They've told us over and over again that they are highly data dependent, and we have to respect that. So we have to see what the jobs report and what the CPI inflation report is going to say.
CPI, September 13th, for those following. Early September, you get the payrolls report. Mohamed, if we can finish on the market, I think we should. Equities today are down about 0.5%, off the highs of July by about 5% on the S&P 500, on the Nasdaq by 8%. High yield spread still incredibly tight. What do you think explains that, Mohamed, given the challenge we see developing in the bond market, with rates of 5% at the front end, close to 450 down the longer end of the curve just yesterday? Isn't that a challenge to this risk appetite in equities, in credit?
It is a challenge, but I think we have to put it into context, John. When we were talking back in July, there was a sense of the market overdoing the romance with the soft landing narrative. And it went too far, both on the bond side and on the equity side. So I see this as a give back after a month of excessive romance with the soft landing. Step back, John, if I had told you in the beginning of the year that the S&P would be up 14%, that the Nasdaq would be up 27%, I think you would have said most investors would have taken that. So, it's important to keep a perspective on this. I think what you're seeing here is people are realizing that it's not going to be as simple as the soft landing narrative that the market fell in love with back in July.
Yeah, sometimes you just got to zoom out a little bit. Coming into this year, obviously, everybody and their grandma was so freaking bearish, right? The bears were ultra bearish, right? We're going down to S&P 3,200, 2,800, 3,400, all their different predictions, 3,000. The bulls were very timid going into this year, not feeling super confident, right? So you had a market that was just overwhelmingly kind of pessimistic and just bearish. And obviously, over the course of 6+ months, you really flipped a lot of that narrative and got investors back over the bullish side. But there is significant risk out there. There's actually more risk in the market today, in my personal opinion, than there was when we actually went into this year, which is hard to believe. There's more risk right now in this market than there was at the beginning of this year. So, don't think we're clear into the good now at this point in time. The risks are adding up. And like I said, the riskiest thing of it all is the longer the Fed keeps rates higher for longer, the more risk it has to the actual underlying economy, which is earnings, which is jobs, which is, everything for the stock market, right? Which is even valuations, because we know valuations get hit hard. Look at where valuations were back in 2009, 2010, 2011, 2012, even as you were starting to get recovery. They were, way down there, because not a lot of people like to take risk. So that's where we get into this very strange stock market we're in right now. And that's why I'm staying very balanced, adding to long positions, hedging up in case crap goes wrong in 24, which is a real potential, and cashing, in terms of just keeping a good amount of cash on the sideline to, just in case. So appreciate everybody joining me as always. Thanks for being here, folks. New all-time high subscribers in the history of the channel, 33,000. And I believe 700 plus now. Holy smokes, this is no joke as we break through that moving average each and every time. If you're looking to apply, join my private group, then fill out an application that will be pinned comment down there. Much love and have a great day.